When we invest in a country, obviously we are interested in growth. We are also interested in the volatility of that growth. You don't want things to go up and then plunge. You want reasonably consistent growth. So it's quite remarkable that in the first 25 years or so, China was able to achieve a growth rate of a double-digit growth rate in nominal terms. That growth rate has now sort of dropped, as you would expect, because the economy is much bigger. It's dropped to maybe about 8% or so, but still a very significant growth rate. That's the backdrop for good investments. You want to invest in countries and in companies which are able to grow. So the factors that I mentioned earlier on has sort of bolstered my confidence about investing in China and also investing in countries who are intertwined with China's growth. But now the challenges are greater. The debt level is higher. There's, the problems associated with shadow banking, and now we have the geopolitical conflict with the United States, which will sort of make greater demands on the quality of the political and economic leadership. It is very, very important for the private sector in China to be given more room to operate, because the private sector is the dynamic part of the economy. You might say it's the new economy, whereas the old economy, is relatively inefficient. The new economy creates most of the new jobs. So for China to maintain very high growth, it requires the private sector to continue to grow. And China will have to move up, you might say, the value-added chain. China is no longer, a low-cost production base. The costs have gone up considerably, wages as well as the currency, and therefore for China to maintain its growth and to raise the sophistication of its economy through technology, it has to foster the growth of the private sector, even as the government puts a heavy emphasis on strengthening the state sector.